In the strongest trends, waiting for a clear pullback is often a mistake. Most traders miss the best moves because they don't understand the difference between a micro channel and a broad channel. The textbook definition of a trend is simple: higher highs and higher lows for a bull market, and lower highs and lower lows for a bear market. While this is technically true, it is not enough to make money in real-time trading. By the time a higher high is confirmed on a chart, the easy money has often already been made. Professional price action traders look at the structure of the individual bars or legs to determine trend health before the pivots form. We must deconstruct the trend into two distinct phases: the breakout, often called the spike, and the channel. Understanding the transition between these two phases is critical for timing your entries. The first phase is the spike. This is a strong trend leg representing urgency. You will see consecutive trend bars with large bodies, small tails, and closes near the extremes. During a spike, the market is one-sided. Bears are trapped and are forced to buy to cover losses, while bulls are adding to positions. This imbalance creates a vacuum that sucks price rapidly in one direction. One of the most reliable signs of a strong breakout leg is the presence of micro gaps. This happens when the low of the current bar remains above the high of the prior bar, or even the close of the prior bar. These gaps indicate that traders are willing to buy at market price instantly, without waiting for even a tick of a pullback. As long as these gaps remain open, the trend is in its strongest possible phase. Eventually, the spike loses momentum. Traders take profits, and counter-trend traders begin to scale in. This initiates the second part of the structure: the pullback. A pullback is a pause in the trend, not a reversal. You identify a healthy pullback by the lack of counter-trend momentum. The bars should be small, often with prominent tails, and they often overlap significantly. If you see a strong bull trend followed by a bear leg consisting of 3 large consecutive red bars closing on their lows, that is not a pullback. That is a reversal or a trading range. Context is everything. Once the pullback ends, the trend resumes. This transition from spike to pullback to resumption creates the channel phase. The slope decreases, but the direction remains up. In a channel, price action becomes two-sided. The bulls are still in control, but the bears are now making money on scalps. This creates a jagged, sawing motion up the chart. We measure these movements in legs. A standard trend structure often moves in 2 distinct legs. This is the concept of measured moves, or AB equals CD patterns, where the second leg is often equal in size to the first. Counting legs is a vital skill. A complex pullback often consists of 2 legs counter to the trend. We call this an ABC correction or a two-legged pullback. Why does the two-legged pullback matter? Because it traps the early bulls who bought the first dip, flushes them out on the second dip, and creates a high probability entry for the resumption. Let's distinguish between strong trends and weak trends. This dictates your strategy. In a strong trend, often called a microchannel, price bars have almost no overlap and very small pullbacks. In a microchannel, you cannot wait for a limit order entry below a bar. You must buy at the market or on a small breakout. Waiting for a deep pullback in a microchannel usually means you missed the trend. Conversely, a weak trend or a broad channel has deep pullbacks. Here, the bars overlap significantly. The market spends a lot of time going sideways to go up slightly. In a broad channel, buying high is suicide. You must treat it almost like a trading range that is tilted. You buy only in the lower third of the channel and take profits in the upper third. Let's look at a specific chart example of a transition. Here, we see a strong breakout leg. Notice the 3 consecutive bull bars closing on their highs. This sets the premise: buy only. Traders seeing this make a mistake. They place a limit order at the moving average, hoping for a deep discount. But because the trend is strong, the market never reaches them. Instead, the market pauses for just 2 bars, a sideways correction, and then continues up. This shallow pullback confirms the urgency. The gap between the breakout point and the pullback low remains open. As the trend matures, the pullbacks get deeper. Look at this later section. Now we see a pullback that lasts 5 bars and tests the moving average. The trend is transitioning from spike to channel. This is where the two-legged rule becomes powerful. When a trend is aging, don't buy the first reversal up. Wait for the market to attempt to go down a second time and fail. We label these entries H1, H2, H3 for high 1, high 2 in a bull trend. An H1 is the first time the high of a bar goes above the high of the prior bar during a pullback. In a strong spike, you buy the H1. In a broad channel, the H1 usually fails, and you must wait for the H2. This filters out losing trades in choppy market conditions. What breaks a trend structure? It is usually not a sudden reversal. It is a transition into a trading range. The higher highs stop, and we start seeing lower highs interacting with previous lows. When the pullbacks become so deep that they overlap with the start of the previous leg, the trend is effectively over. The market has found equilibrium between buyers and sellers. To summarize the hierarchy of trend strength, gaps and spikes are strongest. Tight channels are strong. Broad channels are weak but sustainable. Trading ranges are neutral. Your job is to identify which phase the market is in. If you apply broad channel logic, buying low, to a spike, strong trend, you will never get filled. If you apply spike logic, buying high, to a broad channel, you will lose money. Watch the bars. Are the bodies growing or shrinking? Are the gaps staying open or closing? Is the market stair-stepping cleanly or grinding back and forth? Do not use indicators to tell you this. The price bars themselves are the fastest signal. A moving average lags. A price gap is instant information about order flow. Practice counting the legs. Look for the spike, then the channel. Look for the two legs of correction, ABC, within the channel. This rhythm is the heartbeat of the market. Start by identifying the major higher highs and lows, but refine your view by looking at the buying pressure within those moves. That is the Al Brooks edge. In the next video, we will focus specifically on signal bars and how to identify the exact candlestick that tells you to enter the trade once the structure is aligned. Don't fight the trend. Wait for the setup.